All right, listeners, welcome back to TalkTickers. You know the drill. We're your trusty guides through the jungle of earnings calls, hacking through the vines of financial jargon so you can, actually understand what these companies are trying to tell us.
Oh yeah, deciphering corporate speak, that's our specialty. It's practically an Olympic sport at this point.
This week, we're strapping on our virtual safari helmets and venturing into the world of SAP's Q3 2024 performance. Buckle up, because they're claiming to be well ahead of plans.
Well ahead of plans. Those are fighting words in the financial world, aren't they?
Oh, absolutely. But we all know those carefully crafted press releases and investor presentations. Gotta dig a little deeper, right?
Exactly. Peel back the layers of the onion, see if there are any tears underneath.
Speaking of peeling back layers, let's bring in our resident numbers ninja, who can spot a suspicious spreadsheet from a mile away.
I've got my magnifying glass and my trusty calculator ready to go.
Excellent. SAP's been making a lot of noise about their business AI lately, but we're here to determine if it's the real deal or just a shiny new marketing buzzword.
I've got my BS detector on high alert.
Okay, let's fire up the Jorgen Buster 3000 and tackle some of these financial gems. First up, current cloud backlog, clocking in at a cool $15.4 billion. Sounds like they're swimming in cash, right?
Well, not so fast. Think of it this way. That $15.4 billion is essentially a stack of future promises from customers for their cloud services. It's good news if those promises turn into actual revenue, but it's not a guarantee.
So it's more like an overstuffed inbox of maybe RSVPs to a party. You hope people show up, but you're not ordering extra pizza just yet.
Exactly. Don't count your chickens before they hatch or your cloud backlog before it converts to revenue.
Fair enough. But they also boasted a cloud revenue growth of 27%, which seems a bit more tangible.
Now, that's a number worth celebrating. 27% growth means their cloud business is actually gaining traction, bringing in cold, hard cash. But here's the interesting part. That growth was almost entirely organic.
Organic? You mean they grew it themselves without any fancy acquisitions or mergers?
Precisely. No big spending sprees to artificially inflate those numbers.
So they're relying on good old-fashioned hard work and salesmanship. Not as flashy as a multi-billion-dollar acquisition, but maybe a sign of sustainability.
It's a sign they're focused on making the most of what they've got, squeezing every last drop of revenue out of their existing customer base. It could be a smart move in a volatile market, or a sign they're too scared to take risks.
Makes you wonder what's going on behind the scenes, doesn't it? Are they being cautious or just plain cheap?
Well, we'll have to see what their M&A activity looks like in the coming quarters. For now, let's move on to our next jargon gem.
All right. Next up on our decoding adventure is non-IFRS operating profit, which saw a whopping 28% increase. Sounds impressive, right?
Sure, but you always have to approach non-IFRS numbers with a healthy dose of skepticism.
Oh, come on. They can't be that bad. It's just a different way of looking at things, right?
Right. Think of it like those filtered selfies everyone posts on social media. They smooth out the imperfections and present a slightly idealized version of reality.
So what wrinkles are they hiding under that non-IFRS makeup?
Well, these non-IFRS figures conveniently exclude certain costs, like restructuring charges or one-time expenses. It allows them to highlight their core business performance, but it's important to look at both IFRS and non-IFRS numbers for the complete picture.
So it's like checking both the filtered and unfiltered photos before swiping right on a dating app. You guys see the whole package.
Precisely. You need to be a discerning investor, just like a discerning online dater.
All right, enough with the jargon. Let's activate the CEO decoder ring and see what cryptic messages CEO Christian Klein is sending out to the world.
Oh, I love this part. It's like analyzing ancient hieroglyphics, except instead of pharaohs, we have CEOs.
Klein was practically doing a victory dance over their Rise with SAP program and boasting about how their business AI is attracting major clients like the Schwartz Group.
Little and Coughlin listeners, those are some big names in the European retail world.
Exactly. So what's the deal with this Rise with SAP thing? Is it just another corporate buzzword, or is there some substance behind it?
It's basically their bundled package deal for businesses that want to modernize their operations. Think of it like a one-stop shop for all your digital transformation needs. And yes, AI plays a big role in that.
So it's like a digital makeover package for your business, complete with an AI stylist to pick out your software solutions. Sounds intriguing, but is there a hint of desperation in Klein's enthusiasm? Are they just throwing AI spaghetti at the wall and hoping something sticks?
Well, his emphasis on organic growth suggests they're focused on maximizing their current customer base, which could be seen as both prudent and a bit cautious. Maybe they're playing it safe in a turbulent market, or maybe they're just hesitant to make any big moves.
Intriguing. It seems like there's a lot more to this story than meets the eye. We've got jargon, we've got AI, we've got a CEO who's either cautiously optimistic or just plain confused. This is shaping up to be a classic TalkTickers mystery.
Stay tuned, listeners, as we unravel the enigma of SAP's Q3 2024 performance.
We'll be right back after a short break.
Welcome back, listeners, to the wild world of SAP's finances, where we're trying to figure out if this tech giant can keep growing without, going on a shopping spree.
Yeah, because so far their strategy seems to be all about squeezing more money out of their current clients. It's like they're trying to make a five-course meal out of like half a bag of chips and some expired ketchup.
It's a creative approach, I'll give them that. But yeah, you can only stretch those resources so far. So the big question is, can they maintain this growth without making some major acquisitions?
Because let's be honest, acquisitions, those are the juicy bits of the financial world. It's like corporate matchmaking with billions of dollars on the line.
And sometimes those matches work out beautifully, sometimes they end up in a messy corporate divorce.
Exactly. It's a high-stakes game, but it can pay off big time if you get it right. So is SAP's M&A team just being extra cautious right now, or are they missing out on some golden opportunities?
Well, it's a tough call. The market's been a bit unpredictable lately, so maybe they're just waiting for the right moment to strike. But if they wait too long, those opportunities might disappear.
Speaking of opportunities, let's talk about their AI strategy. I mean, every tech company under the sun is throwing around the term AI these days.
Oh, yeah. It's the hottest buzzword in the industry. But the question is SAP actually delivering real value with their AI solutions, or is it just a marketing gimmick?
Because remember, they've got this knowledge graph thing they keep talking about. They're using decades of data to train their AI to understand like specific industries and business processes.
It's like they're trying to create a digital brain for businesses, a brain that can sift through mountains of data and make intelligent decisions.
Sounds pretty ambitious, right? But can they actually pull it off? I mean, AI is still a relatively new field, and there are a lot of unknowns.
Absolutely. It's a gamble, but it's a gamble that could pay off big time if they get it right. If SAP can truly leverage AI to help their clients become more efficient and profitable, then they could be in a very strong position.
Of course, we can't forget about those internal shakeups they've been having. High-level departures, restructuring programs. It's like they're rearranging the furniture while the house is still under construction.
Oh, yeah. Those internal dramas can definitely impact a company's performance. You've got changes in leadership, shifts in strategy. It can all be a bit, chaotic.
And chaos is not usually a recipe for success in the business world. So the question is, can SAP navigate these changes smoothly, or will they stumble and fall behind their competitors?
We'll have to wait and see. But it's definitely something to keep an eye on, because if they can't get their internal house in order, it won't matter how brilliant their AI strategy is.
Okay, let's shift gears a bit and talk about their software support revenue. Remember, they've been pushing hard towards the cloud, right? Trying to get everyone on board with their cloud-based solutions.
Right, and that's been a key part of their growth strategy. But their software support revenue, which is tied to their older on-premise products, well, that's been slowing down.
So is this a sign that their cloud transition is hitting a snag? Or is it just a natural part of the process? I mean, as more people move to the cloud, you'd expect those older revenue streams to decline.
It's a bit of both, I think. The transition to the cloud is never a seamless process. There are always going to be some bumps along the road. But the key is to make sure those bumps don't turn into major roadblocks.
Because if SAP can't keep that cloud momentum going, they could be in trouble. The cloud is the future, and if they fall behind, well, that's not a good look for any tech company.
Absolutely. They need to keep innovating, keep pushing the boundaries, or they risk becoming, irrelevant.
So it sounds like SAP is facing some tough challenges, but they also have some big opportunities ahead of them. It's a classic tale of risk and reward, isn't it?
It is. And that's what makes the business world so fascinating. You've got these massive companies with billions of dollars at stake, making these strategic bets, hoping to stay ahead of the curve.
And we get to watch it all unfold from the comfort of our podcasting studio.
With our trusty calculators and our Jargon Buster 3000.
You know, I think I need a break after all this financial analysis. My brain is starting to feel like a spreadsheet.
I hear you. We'll be back in a moment, listeners, with the thrilling conclusion of our SAP Deep Dive.
And we're back, listeners, for the grand finale of our SAP earnings call extravaganza. We've explored the financial wilderness, battled jargon monsters, and emerged, hopefully, a little bit wiser.
And maybe slightly more caffeinated, these earnings calls, they can be a real mental workout.
Oh, tell me about it. But that's what we're here for, right? To break it all down for you, our intrepid listeners, and help you make sense of these corporate financial puzzles. So, let's recap, shall we? What are the key takeaways from this SAP deep dive?
Well, the big picture is that SAP is actually doing pretty well, considering all the economic turbulence out there. Their cloud business is definitely a bright spot, growing like a weed.
Yeah, that cloud revenue is looking pretty juicy. It's clear they're putting a lot of eggs in that basket, and so far, it seems to be paying off.
But they're not without their challenges, right? They need to find new ways to grow, new revenue streams, or they risk becoming too dependent on squeezing their existing clients.
Like a hamster on a wheel, running and running, but not really getting anywhere new. So acquisitions, new markets, something's got to give, right? Otherwise, that growth might start to sputter.
Exactly. They can't just rest on their laurels. The tech world is constantly evolving, and if they want to stay ahead of the game, they need to keep innovating, keep pushing the boundaries.
And let's not forget about those internal shakeups, right? Leadership changes, restructuring programs, all that can be pretty disruptive to a company's overall strategy.
It's like trying to change the engine of a car while it's still running. It can be done, but it takes a skilled mechanic and a whole lot of luck.
So what's the verdict? Is SAP a buy, a sell, or a hold? What should our listeners be doing with this information?
Well, I'm not giving out financial advice. That's not my game. But I will say this. SAP is a company with a strong foundation, a long history of success, and a clear vision for the future. But they're also facing some real challenges, both internal and external.
So as always, do your research, folks. Don't just take our word for it. Dig into those financial statements, read those analyst reports, and come to your own conclusions.
Because at the end of the day, it's your money, and you need to be comfortable with the risks you're taking.
Well said. And on that note of prudent financial advice, it's time for our completely absurd, totally not to be taken seriously stock tip of the week.
Oh, I love this part. What gem have you unearthed for us this time?
All right, listeners, here it is. This week, we're recommending you invest in companies that manufacture comfortable chairs specifically designed for listening to earnings calls.
Because let's be honest, those calls can be long and sometimes a little bit dry. You need a good chair to keep you awake and engaged.
Exactly. Ergonomic support, adjustable lumbar settings, maybe even a built-in cup holder for your coffee.
Now that's an investment I can get behind.
And there you have it, folks. Another TalkTickers episode in the books. We've tackled SAP's Q3 performance, decoded the financial jargon, and hopefully given you a few laughs along the way.
Remember, knowledge is power. And in the financial world, power means making informed decisions and hopefully growing those portfolios.
Thanks for joining us on this wild ride, listeners. Until next time, happy investing.